In this video, we're going to take a look at the Japanese stock market index and find out a bit more about it and why it's so popular with traders. Hello, I'm David Jones from Capital.com, and this is the latest in our series where we look at markets that are popular with traders. This time around, we're going to take a look at the Nikkei 225, the Japanese stock market index. We'll take a look at what makes it up, the sort of volatility it has, and how to trade it. So let's get started. So let's take a look at the Japanese Nikkei 225 and see why is it so popular with traders. Well, it's Japan's blue chip stock market index for the Tokyo Stock Exchange. It tracks the value of 225 of the biggest companies from a wide mix of different industries. As usual with indices, it's a way of gaining broad exposure to shares in that country. So in this example, it's a way of getting exposure to large Japanese listed shares, and its daily volatility is what appeals to shorter term traders who are looking for decent swings throughout the trading day to try and profit from. So how do you trade the Nikkei 225 with Capital.com? You trade contracts for difference, CFDs, on the Nikkei, and that's the Japan 225 is what it's known as on our platform. You may be familiar with CFDs. With these, you trade using leverage. And what that means is a small sum of money controls potentially a much larger position. So traders use leverage in many markets to try and magnify their profits when they're right. But of course, hand in hand with that goes the risk of magnifying their losses when they're wrong. So it's even more important than ever when you're trading using leverage to use some sort of risk management approach such as stop losses. And when you're trading using CFDs, you can trade markets in both directions. So if you thought the index was going to rise, you'd buy using CFDs. You're going long, expecting the market to rise. But if you thought the stock market index was due a slide, you can sell short. So you sell to open your position, hoping to profit from the market falling. Here's a quick look at the longer term for the Nikkei. Going back to October 2018, the market was trading at 24,400. This big sell-off then into the end of 2018 saw the Nikkei down around about 19,300, and then the corresponding bounce back of about 3,000 points. So plenty of volatility over that time period. Let's take a look at something a bit shorter term. So here's the last couple of days, and you can see here, just over the last few days, the market's gone from 20,800, these lows, up as high as 21,280. So even over a few days, we've seen moves of 300 to 400 points, and it's this sort of short-term volatility that traders really love. So like many of these indices, the Dow, the DAX, the FTSE, it's the day-to-day volatility that traders really enjoy. Typically traders are looking for a move in a market, so when we have these volatile markets, they tend to be the ones they flock to. You can trade it using contracts for difference, CFDs, with Capital.com. The benefit of that is you can trade the market in both directions. So you think the Nikkei is about to take a turn for the worst, you can sell short. You use leverage, of course, and with that it's important to understand that you're magnifying your potential profits, but you're also magnifying your potential losses. So it's very important to use risk management controls such as stop losses. But you can find out more about CFDs on the Capital.com website. We'll wrap things up there. So for this brief introduction to the Nikkei 225, we'll leave it there. So from me, David Jones, and Capital.com, good luck with your trading.